This is Barry Zalma speaking for Zalma on Insurance, a YouTube channel. I am an attorney who has retired from the practice of law and now spend my time acting as an insurance claims consultant, an insurance claims expert witness, an author and producer of these video discussions about subjects of importance to everyone in the business of insurance or who are interested in insurance. Today we're going to talk about 3 squares and a cot, why insurance fraud should not be a retirement plan. Every insurer is required by its shareholders, members, state statutes, and state regulations to do everything possible to deter and defeat attempts at insurance fraud. Most insurers, therefore, have a staff of fraud investigators working under their Special Investigation Unit, an SIU, and the SIU works to train the claims handlers to recognize the indicators of red flags of fraud. Much to the surprise of the public, lawyers, even some judges, defrauding an insurance company is a crime. In most states, insurance fraud is a felony that could subject the perpetrator to as much as 5 years in state prison plus serious fines. If the fraud is attempted by use of mail or telephone, internet, email, or against a federal insurance program like Medicare, Medicaid, or the National Flood Insurance Program, it can also be a federal felony where you will actually spend time in jail for the full amount of time ordered by the judge. Insurance fraud is a crime that should be easy for a prosecutor to prove, since all that is required is to prove that the insurance criminal knowingly presented a claim for the payment of insurance contract benefits to which the perpetrator is not entitled, or the submission of a single false document or a single oral statement in support of the crime. However, state prosecutors are reluctant to prosecute the crime, regardless of the state where it is committed, because they believe it is their duty to prosecute only violent crimes. Financial crimes, like insurance fraud, they believe only hurt rich insurance companies and are not worthy of their efforts. Because of the lack of aggressive prosecution, insurance fraud attempts often succeed. In fact, more succeed than don't. No one really knows how much money insurance fraud takes from the insurance industry because not all fraud attempts are discovered. The best estimates, the best guesses of insurance fraud professionals about the cost of insurance fraud conclude that fraud takes between $80 billion and $300 billion every year. Even those who are convicted are ordered to make restitution of less than the amount they probably stole, and are given probation or a short time in jail. Those who are imprisoned will still have part of their ill-gotten gains left to live well upon their release. Many, after arrest or conviction, work to run more fraudulent claims to pay the ordered restitution and the lawyers who are getting them off. There is, however, as my last 52 years in the insurance business indicates, that there's a change in those who commit insurance fraud. Fraud perpetrators, when I began in the business 52 years ago, were usually young, with some middle-aged. It seemed that none were of retirement age or elderly. Claims presented by the elderly were paid with little or no investigation. Today, as people in the pre-baby boom generation and the baby boom generation, those born after the end of World War II, move toward retirement, they find they have spent everything they earned in their youth to support their children and elderly parents and a comfortable lifestyle. When they decide it is time to stop working, they are shocked to find that they have nothing left to support them. Since they are quickly becoming physically unable to continue to work, their moral compass spins out of control. For example, a person 65 years old or older can't afford to live on Social Security benefits, especially in expensive to live in states like California or New York. Because the felony of insurance fraud is seldom prosecuted, because prosecutors complain they are compelled to deal with injury-causing violent crime before a crime against an insurer for nothing more than money just doesn't interest prosecutors. I have been writing Zelma's insurance fraud letter twice a month for more than 23 years, and have seen that more and more people who are convicted of insurance fraud are above the age where they can collect Social Security. Many are professionals, doctors, chiropractors, nurse practitioners, and lawyers. Those who determine the only way they can gather sufficient funds to support a comfortable retirement is to engage in insurance fraud. They have not read the criminal statutes making insurance fraud a crime or the federal statutes making it a crime to take advantage of government-created quasi-insurers like Medicaid and Medicare. As a result, some are caught, prosecuted, and convicted of insurance fraud, wire fraud, or health care fraud. Unfortunately for the public, most are not. The insurance claims and SIU investigators, therefore, must consider the elderly as a potential fraud perpetrator. Most of the elderly professionals, by definition, are high earners who had income sufficient to invest and save for their retirement. There seems to be no logical reason that such a professional would even think about insurance fraud. However, many of the people in my age cohort, those born after the onset of World War II, had it too good. They earned a lot, and they spent everything they earned, and borrowed money allowing them to spend more than they earned. Insurers must train their claims and SIU personnel to disabuse them of the prejudice that brings about the belief that an elder will not consider defrauding the insurer. Any one or more of the fraudulent claim events that fit within the definition of insurance fraud must be discovered by every insurer and reported to the state's Department of Insurance or prosecutors as suspected insurance fraud. Professionals have been known to profit from insurance fraud in different categories, like medical professional fraud, property insurance fraud, and legal professional fraud. Consider as the starting point medical professional fraud. Most health insurance fraud perpetrators should be easy to catch if the insurance company, SIU, the Department of Justice, the FBI, or Health and Human Services investigators had the funds to properly and effectively investigate the crimes. The methods used by healthcare providers to defraud insurers and Medicare or other government programs include any possibility to bill an insurer or government-based organization, Because the government medical assistance programs are bleeding cash, the Department of Justice is becoming more aggressive in their efforts to stop fraud. They are limited by their funding to investigate cases in major metropolitan areas. As a result, most health insurance crimes are not prosecuted because they are perpetrated in areas where the prosecutors are not working. Property insurance fraud, on the other hand, is something insurance companies are designed to deal with. Insurance companies, however, bound by the implied covenant of good faith and fair dealing, and state insurance department regulations are required to believe those who seek insurance about the value of the property, the risk of loss of which the insurer agreed to insure. A professional would not be questioned if he or she presented a request to insure jewelry, furs, sculptures, paintings, or antiques with high valuations. The scheduled personal property insurance policy, called the Personal Articles Floater, or PAF, is an all risk of loss policy with few conditions or exclusions. If an insured has a schedule of $2 million in jewelry based upon a fictitious appraisal, the policy can be turned to cash by advising the insurer that the jewelry was lost. The policy doesn't require a theft. You can just misplace your personal articles and they're covered. A few years ago, I represented an insurer who was faced with an unusual theft claim presented by an 85-year-old grandmother who claimed her major schedule of antiques, silver, china, and fine arts were stolen by a cleaning person she had hired from a notice on her grocery store bulletin board. She claimed the cleaning solution fumes had caused her to faint, and when she came back to her senses, the cleaning person, Juanita, whose last name was unknown, was gone, and all the grandmother's property left with Juanita. The claim was for more than $1,750,000 and was supported by an appraisal with detailed description, hand-drawn images of each item appraised, and signed by the appraiser. It took my investigator 3 months to locate the appraiser. The appraiser, regardless of the date on the appraisal, which was current, had died in the attack on Pearl Harbor and was buried in Oahu in December 1941. The claim was denied. The grandmother contacted multiple lawyers who would call every 3 months or so, threatening to sue the insurer, and only gave up when I advised the lawyer of how the fraud was detected. Eventually she gave up and probably presented a claim to a different insurer. Insurance claims adjusters, special investigation unit investigators, claims management, fraud division investigator, FBI agents, HHS agents must all understand that because a person is elderly is not a reason to conclude a claim is honest. The professional claims person should never believe it is impossible that an old man or woman, especially if the old man or woman is a doctor or a lawyer, would commit fraud. Rather, the insurance claims professional should understand there is a higher probability that a major claim presented by an elderly person is an attempt at fraud than a claim presented by a millennial. Regardless of the age or profession of the person making a claim, if 3 or more red flags of fraud appear in the claims investigation, a detailed and extensive insurance fraud investigation is required, and if it establishes that a fraud is being attempted, the claim must be rejected, and any lawsuit that follows from the insurance fraud perpetrator's settlement should be refused and trial required, up to and including an appeal to the highest court in the state. Insurance fraud continues daily. Zalma's insurance fraud letter, which is available free on the internet from my website, www.zalma.com, is going on forever, is continuing, and now we are seeing doctors who have stolen multiple millions of dollars from Medicare and Medicaid and the health insurance industry. And they are offering for a lighter sentence to repay what the government thinks they stole. And they're repaying it with cash. And if they have the cash to repay what they stole a great deal more than they are admitting to, and that the government investigators were able to prove. These people should be sentenced to jail. And it matters not that the doctor is 72 years old, has stolen $20 million from the federal government, and seeks mercy on the grounds that if he's sentenced to more than a year or two, he will die in prison. Mercy is something that the U.S. government can no longer afford. Thank you for your attention, and if you found this video to be of interest and use to you, please subscribe to the YouTube channel, Zalma's Insurance Fraud Letter, and my blog. Thank you again.